The next speaker which we have is Mr. Amitabh Vatsya. He's a founder at institution called Sadhan with experience in debt, capital markets, structured finance, and project finance. Mr. Amitabh has a strong understanding of capital markets, and you can see his presentation and investment awareness program on different social media channels like YouTube and everywhere else outside as well. So, Mr. Amitabh, over to you. Looking forward to learn from your analysis and the idea which you are going to present. Over to you, please.
Thanks for inviting me into this conference. So let me start with my presentation. Just a brief introduction of mine. I've done my MBA from IIM Mumbai and had been investing since last 7-8 years, and last 3 years I'm full time and I'm trying to share whatever I've learned. So little success I have had. So I'm trying to share it with the wider audience in the form of YouTube videos. I also run a course where I try to share whatever I've learned over last 7-8 years. And also as a banking professional, I've learned a lot because I was looking at it from the banker's angle. So that has led to some success, which is quite unique. So that's why I'm trying to share it in a form of course. But let's begin today's journey, which is about green energy stock. So why green energy? Because wind sector has been at the cusp of things, and it has been talk of the town since the days Suzlon had come with an IPO, and there has been lots of heartburns for many investors. So I had witnessed the sectors for quite 10 years. And I realized that this time of this sector has come now, although we always keep hearing about solar nowadays whenever we talk about renewable. But why I think we are missing the big picture in terms of the sector. So solar is talk of town, but I will give you reasons to believe that why wind is next mega theme. Standard disclaimer, I'm not a SEBI registered advisor or any financial advisor. This is only for educational purpose. And I am holding stock which we are going to discuss. I follow regulations quite closely, and I realized that there had been certain steps taken by Government of India. They have identified wind as a separate column of renewable purchase obligations. So what does this mean? This means that a DISCOM has to compulsorily purchase certain portion of their power from wind, and that obligation is valid till 2030. Then there are a couple of changes which has been common with solar, which was like certain charges, which was interstate transmission charge system charges. Those were waived off till 30th June 2025. But that is not the crux. The crux here is that the whole industry cannot grow without power, and power has to be round the clock. So that's why there is a need of round the clock power system. And round the clock power system means not just day. You need power at night. That's why the rise of hybrid power, which sometimes means having solar, having wind, and also having pumped hydrogen or battery, BESS. But whether you choose BESS or you choose a hybrid power or a pumped hydro, there has to be a complementary setup of solar plus wind. So wind is the common factor across all the things. And why it is better than solar? Because I have studied both the sectors. I have been studying solar since 2013 when it was called Jawaharlal Nehru National Solar Mission. So I know that solar takes lots more land than wind. And also the capacity utilization factor, which is typically around 30% in wind, that is quite low at 20% in solar, which means wind is at least 1.5 times more efficient production wise. And in land size, I should at least talk about at least 2 to 3x kind of lesser space needed for having a similar sized capacity in wind. And India is not USA or Russia or Canada, that we are living in a place where we have 100 billion population is also fighting for that same space for agriculture and for n number of things. So that's why having a land constraint is going to be the game changer reason for wind particularly. Also, government has said that since we have limitation of land, so they have given incentive in terms of viability gap funding, which was around 7,453 crores for setting up 1 gigawatt of offshore wind power mills. Offshore means which is on the sea shore. So it has to be outside the land masses. So that is also a welcome step for the rise of wind sector. So wind sector over the years, if we have a look, then we'll realize that India has kind of jumped the ship in last 1 year itself with around 63% generation added. And that is onshore because India doesn't have any offshore plant right now. But if you look at world where we have onshore as well as offshore, so wahan pe the jump is also quite significant, which is 50%. So the whole world, including India, is growing at more than 50%. So there has to be an opportunity for us to find our next multi-bagger. And that's a very obvious choice for me when I look at the value chain. All the major industries think tank are expecting a 9.4% CAGR into international market global wind installations. But right now we would look at a company which is not just present in India but also catering to international market. So we have to look at both the picture. So that's why this is going to be slightly more engrossing, and I need you guys attention to the facts which I'm going to share. So let's look at India first. So India में अभी क्या हुआ है कि, as I said, that since Suzlon has come with an IPO way back in 2010 and all, but FY17 was the peak time when the wind was the hotcake. At that time, we have done around 5.4 gigawatt, which means 5,400 megawatt of capacity. And we never surpassed that. And this is the year, FY24, which we tried to cross at least halfway. We are 3.25 gigawatt in terms of addition in this sector. So India globally ranks around fourth in the total world installation with around 46 gigawatt of installed onshore wind as of March 2024. And you would notice that since 18, when the capacity was as low as 1.76, now we have doubled to 3.25. The company which I'm going to talk about has grown its revenue by 4x. So we need a winning sector as well as a winning combination. That's why I'm trying to bring focus to a stock which is a small cap. But before we go there, let's have a look at the recent data. The data suggests that in H1 FY25, the wind installation has grown by around 15% YOY basis till 6 months. And if you look at the pipelines, if you look top right, then we'll notice that the wind sector has a pipeline of around 18.2 gigawatts. So we were just last slide, we were talking about 3.2 gigawatt, and now we are talking about 18.2 gigawatt. That is under pipeline and around another 5 gigawatt under bidding stage. So under bidding means maybe 2 years, but under pipelines literally means 18 months, 20 months, 22 months types for me. So that's where I'm talking about the growth which we are going to witness in wind is in terms of 3x, 4x at the minimum. Let's have a look at the near-term outlook, short-term outlook, which has been shared by a JMK Research, a third-party consultant who look at this sector very closely, and they are expecting H2 FY25 to be additional 2.6 gigawatt additions. So far, we have done around 2 gigawatt in this year and around 2.5 more in coming 6 months. So things are quite windy for wind power. So let's look at the value chain. So whenever wind power plants are made, wind turbines constitute around 64% of the capital cost. And across this wind turbine, if you look closely, then we'll figure out that there's something called gearbox, which generally commands around 12% of the capital cost. And there are rotor blades and other things which are actually made out of iron, and those things need to be built in a casting plant. And that's why casting become a major cost head of our overall wind power plant. So there is a case for investing into wind casting industry. I looked at Indian market, who are the players who are doing the casting for this kind of turbines. Typically, no turbines has a bigger structure. It has the major casting portion in the central part. So there are three companies. One is SE Forge, which is basically a Suzlon subsidiary. They have the largest capacity of 120,000 MTPA, metric ton per annum. Then there comes a Batter Casting, which is actually a company which is having a similar size, which is 30,000 MTPA with the company I'm going to talk about. So Batter Casting is having 30,000 MTPA, but we should notice the projected capacity by 2025 for Batter Casting is going to be 50,000 MTPA. So they are also thinking of expanding. And the company in focus is SGIL, Synergy Green Energy Industries Limited, which has a similar current capacity. And they are going to add another 50% in next 6 months, 8 months. If we try to have a look at the peers, then batter casting is having a major client, which is Vestas, and SGIL client list I'll talk about. So SGIL has a capacity of building up casting product up to 23 tons. So SGIL has a specialty of having India's largest semi-automated fast loop molding line for large size casting. So they have a automated kind of plant, so that they are quite efficient. I mean, you would know why they are efficient when I'll talk about the management. So they cater to wind turbine makers, and their main product is going to wind. 85% revenue comes from wind, and 15% comes from general engineering. So, what are the important milestones for this company? This company had been in focus by major clients like Siemens Gamesa, which was India's largest OEM back then in 2015. This company has acquired them as a client in 2015. Then 2016, they added Vestas, which was number two. And that time, Europeans were ruling the roost. So having two major European companies as their client, they moved to 10,000 MTPA plant in 2017. And then 2019, this IPO came after 2017, and they raised fund. And thanks to that fundraising, they increased the capacity to 3x. That was the year. And since then, there has not been a major thing which I can talk about. But 2024, which is just last week, actually, they have acquired a major client, which is Envision. So I'll talk about Envision more. But before going there, let's have a look at the core construct of the management. This is a part of a Sirgaonkar group company, which is Kolhapur-based company. So they have other businesses, like they run hotels, and they are into engineering companies also. So there's the man in focus is Mr. V. Srinivas Reddy. He is 54-year-old, and he has a stellar experience into working with L&T, SGIL, which is again a capital good company. But one thing which caught my eyes is his degree. If he holds a degree of Master in Technology from NIFFT. And I have my friends from NIFFT, so I know its full form, and it is National Institute of Foundry and Forge Technology. He has done Masters in Technology, kind of MTech from there. So this is the best qualifications one can expect to be before launching a foundry business or casting business, because casting is a foundry business. So he is the man. He handles various responsibility of developing product and operational management. So he is the man to watch out for. But the main thing to watch out in this presentation is the customer, because the customer holds the key for this company. And first thing why I got interested in this business was because I've seen Siemens Gamesa as their client. And I know for the matter of fact that these guys, Siemens, they don't give business to just anybody. They conduct a very long step process before onboarding any supplier. Their revenue shares is just 9.8%, but there is a bigger company, which is Vestas, which has around 24% revenue contribution. And second was Senmion Wind Technology. But let's have a look at the bigger list, which have other interesting name like Adani, GE Renewable, and ZF. So ZF is a non-wind customer. ZF is a major automobile supplier, which makes best gearbox in the country and in the world itself. But let's keep that 15% business aside and have a closer look at the clients it has. So they all are leading wind OEMs in 2023. And you can see green boxes, companies like Vestas, GE, Siemens Gamesa, their capacity are given. They rank among top 10, Vestas being third, and GE being sixth, and Gamesa being eighth. Let's go back in time, just 1 year back. And 2022, I dig down what was the contribution of these players in the overall global wind turbine market. So I added SGIL's customer business in FY 2022 on the right side and 2023 on the left side. And 2022, it was 26 gigawatt, and 2023, it was 28.6 gigawatt, which means they are riding on the right horses. But the main thing which we need to look at is the client onboarding in progress. So in the both side, you can see there are two companies, Envision and Nordex, which was shown as the client being onboarded, not yet fully onboarded. So this was a kind of a dangling matter for quite quite a year. You can see clearly. I'll share that Envision has been onboarded. Nordex already had been onboarded. So if we add Envision and Nordex, both of them has actually grown. Nordex has grown from 4.7 gigawatt to 6.7, and Envision has been number 4 globally. Now they jumped to number 2. So Envision is the fastest horse in the town. And so let's look at the product more closely. Then we figure out that this in the wind turbine, there is something called blade, which you can visibly see. Then behind the blade is the engine, basically the core construct of the intelligent part, or you can say the main force behind the wind turbine, that is called nacelle. And inside nacelle, there are many small, not small parts. They look very small in the diagram, but these are like, they weigh around ton. So these are the gearboxes actually. So these gearboxes are very critical for a success of a wind turbine. If you happen to know why Suzlon could not do well globally, because at one time they were touted as the best, because they struggled to improve their gearboxes and they started failing in 2010-11, and that's why Suzlon stock has tanked from 1,000 to 40 and 20 and 8 rupees level. So that's important. That's the importance of gearbox, so to say. So this company makes crucial parts for gearbox, not just wind, but also non-wind player also. So their specialty is into gearbox, and their raw material steel prices are going down, and steel is one of their raw material, steel scrap to be very precise. So scrap sales has been, in 1 year, it has been flat. So that constitute around 43%. Pig iron is another proxy on steel. So it's the same thing almost. So both the prices, sponge iron or pig iron, I've taken sponge iron as a proxy on pig iron. So that they also have fallen down over the year. So the raw materials prices are benign for them. But why this company is interesting is not because the placement they have in the value chain. What is in making? And in making is a Capex. And they are growing from 30,000 MTPA to 45,000 MT in next 6 months. 6 months, doing a Capex of 60 crore on foundry and 65 crore on machining. So machining is very important part for any casting company, because casting is slightly a not so super skilled job, but machining is the super skilled job. And once you do machining, then your margins expand. I'll share my experience with Pitti Engineering. So they have installed machine capacity and their margins has broken off. And that's why Pitti Engineering got re-rated. This company is also positioned in that leg, that stage where their margins would expand. Currently, they are outsourcing 100% of machining. They are saying that if they would insource this in-house machining, say they will save 3% of their margin. You can see the margin breakup, the cost structure. Currently, they are operating at 12.6 percentage of margin, out of which machining has 10.4% of cost. And so 10% cost would kind of go down drastically. So that would lead to 3% margin expansion. Also, they are going to reduce power cost, which is around 8% by setting up a solar plant with 32 crore of Capex. So that would again reduce the cost by 2%. So roughly 5% kind of margin expansion they are expecting. But let's look at the timelines. So out of this 157 crore of Capex, they are expecting a right issue. They have already raised right issues. Now the next milestone is the expansion from 30,000 to 45,000 MT. That is going to happen by March 25 as per the management. And captive solar power plant will also be ready. And it would be 10 megawatt. So it would take care of the future need of the company in terms of power requirement, because 10 megawatt is a big power plant for them, for this small company. And this machining facility would be ready by September 25. So FY26 is the year when they will have the full scale of this. So this is the Capex plan. But let's look at the present scenario. Top line, it has grown from 200 crore top line in 21 to 328 in FY24. Although they have given a better guidance, they have expected to be 350 crore, but there was a 700% kind of reduction from the guidance. So that's why one thing which we need to take with a pinch of salt is the guidance of the management, because in the past they could not have delivered. A business model is so strong. I'll talk about the breakup of their top line. So they are equal footed in terms of export, domestic, as well as OEM export. So what is OEM export? They have clients like Vestas and Siemens. So they are the global leader. So their wind turbines have demand into Europe also. So these OEM says that you make these parts not just for India but for international market. So these are like a deemed export. They are OEM export. So roughly one third is export portion, OEM export, and one third is domestic. So that's why I'm saying that export is also important, but domestic story is also mainstay for this company. So let's look at the business model closely. 1 megawatt of wind turbine requires around 12 to 13 ton of casting. So there are, I just said that 18 gigawatt of capacity is under pipeline. So that amounts to around 2.25 lakh metric ton of casting weight. So if we multiply it with the realization, which is around 140 rupees per kg for this company, then we get a TAM of 3,000 crore. That is total domestic TAM. I'm not talking about international market. What does this mean for this company? But before going to TAM, let's understand the pricing power of this company. As per their CRISIL rating report, they say that this company is able to pass on the price rise to customer only after a lag of 1 to 2 quarters. So there is 90 days to 100 days kind of receivable risk is there. But beyond that, they have been doing fundamentally very good product development by launching 5 megawatt wind turbines. So if we talk about wind turbines, there are 2 megawatt, 3 megawatt, and 3.34 and 5 megawatt is another class. So if you develop bigger megawatt, bigger size turbines, then you get better wind profile and you get better power production. So that's why the future belongs to the higher megawatt is. And this company has developed 5 megawatt product for Gamesha and Vestas, which are the technology market leader. But Envision is the recent add up into them, and Envision has given them a contract for 5 megawatt. So with Envision, they can do 450 crore of total capacity in this 30,000 MT. Without Capex also, they can do 450 crore with Envision on their side. And I'll talk about Envision more. But just closing the loop on the total addressable market. So current domestic sales of this revenue is 120 crore and total addressable available market was 3,000 crore, as I said in the last slide. So they have around 20% of capacity. They can garner 20% of 3,600 crore. So that is the serviceable available market SAM for them. But if we have just factored in the projects under pipeline, if we look at the bigger picture, then there is a 4x top line growth is possible because National Electricity Plan talk about not just 18 gigawatt, which is under pipeline. They're talking about 122 gigawatt total addition in by 2032. So in next 8 years, there has to be 15,000 crore of addressable market opportunity for these 3-4 players which I talk about. This is the overall market share. So if you are watching this video so far, which means you are a serious investor and you like deep dives like this. So for you, there is a good news that we have around more than 30 plus deep dive videos which you won't get on our YouTube channel at Sadhan Practitioner Membership. There are additional benefit apart from this, and one of my favorite is the community access, because there the whole Sadhan community interacts with each other and there are many good people who keeps their ear on the ground and they share their ideas and also update on the portfolio, which is very important in this investing world. We meet every second weekend online and we interact on the whatever is happening in the portfolio, in the stocks which we own, in the sectors. We go through the deep dives on multiple sectors including data center, green hydrogen, railway, defense, you name it, and we are there just before the crowd arrives. Why? Because we have a very vibrant community. So the bottom line is that whatever I have learned in 10 years of my corporate experience and 5 years of content making as a full-time investor, I have condensed it in a form of a membership, and that is Sadhan Practitioner Membership. So you will find the link in the description. Click on the link in the description, create a trial login and watch the videos which are given there for free. Just now I have released a video on how to read annual report in 2025. All you have to do is go to our website and check the trial videos, which I'm sure is going to add value to your investing career. Key triggers, which we talk about that why you should look at this company, because this company have got orders, big orders from 164 crores from Vestas, which is fundamentally not doing great. We'll know why. Vestas is like the old Petron, and they have developed another wind gearbox manufacturer, which is Flender Drives. So Flender say they've got 65 crore order, and the biggest trigger for them is Envision order, which just came a week back. of around 10,000 MT. So they are running a plant at 85% capacity utilization, which is of 30,000 MT, another 10,000 MT. So this will kind of absorb their full capacity, but this will take time. So the growth map looks like this, that SGIL has a client growth of Envision, plus they have done for Senmion also. उनके लिए भी they have added a new product. They have already developed turbine for Gamesa 5 megawatt, and they are focusing on top 7 OEMs in the world. Then their top 3 customers are Vestas, ZF, and Gamesa right now, but Envision is going to join them. And they are trying to bring automation because they want to conserve energy. And they have got ISO 50001 certification, which talks about that they are practicing energy conservation. They are certified by an auditor that they are practicing those rules which are supposed to be done for conserving energy. And then foundry expansion would be after the capex, and that would increase. As per them, FY27 they can reach 18% EBITDA, but we can debate that. 450 is without foundry expansion. If they do expand this 50% capacity, then 550 to 600 crore of peak revenue they can do, but it would be beyond FY26. It would be in FY27. So if you look at the management guidance, then they are expecting 20% revenue growth in FY25. Export, maybe they are expecting 25% growth against 11.5% in previous year. They are expecting raw material prices to be stable. And if you look at right hand side, then they have a very big plan of going up to 1 lakh MT per annum. But I have given you the background. You can think what they might be having in the mind. But I think the limiting factor for them is their ability to raise fund, ability to manage finances, because they have not been able to scale up really fast. They have taken time from 30,000 to 45,000. Around 5 years they have taken, including COVID years. But I don't see that this thing happening very soon, what they have projected. But still, there would be slightly delay, but someday it would be a possibility. Just to concluding this whole thing, my investing is majorly is into proxy investing. Proxy investor makes more money than the original guy who is doing the job. So who is doing the job is Vestas, Gamesa, and Envision is doing the job. And this company, this guy is having a power of all 3 combined. Envision Energy, let's have a focus on this company because this is less understood company in this whole renewable market. It's a Chinese company basically, but they have BIS certification, Make in India company. They are registered as a approved ALWM. जैसे ALMM होता है सोलर के लिए, वैसे ALWM होता है विंड मैन्युफैक्चरर्स के लिए, अप्रूव्ड लिस्ट ऑफ विंड मैन्युफैक्चरर्स. सो Envision is the bigger name there. Currently they gave them order for 10,000 MT, which has 3.3 megawatt turbines production for Indian market, and they have around 7.7 gigawatt order book in the pipeline. So based on that order book, they have given this 10,000 MT ka order for this SGIL, and this would help SGIL get a better capacity relation for post capex also. So they have onboarded a client, a big side client, which will take care of their future capacity consumption. Product development activity is expected to take approximately 6 months. So this is not immediate, but next year is going to be a serial production time for this company in the second half of FY26. And they have already done similar platform for Vestas and Gamesa. So 2 things are there on the plate in next year: margin expansion because of the initiative I talked about, and top line expansion because of the Envision. But let's look at Envision more closely, and you would know that in India domestic market, Envision commands 41%, which means out of 5 turbines being installed in India, 2 are Envision. So these are shown in red because they are Chinese WTZ OEM, but they have 7.7 gigawatt, which is around majority 40%. So 19.2 gigawatt is the total order book, out of which Envision has 7.7 and Suzlon and others have a minor share into it comparative to Envision. So that's why onboarding of this client was a game changer for them. And this company has done their first con call post that win. So the company is full in confidence. But keeping that aside, let's look at it whether this company can be a multi-bagger or not. So at Sadhan, we have a multi-bagger framework, and there are multi facets to it. I don't have time to explain that, but one crucial element I would like to talk about is a degree of operating leverage. So there's a formula which we operate, and that formula we calculated for this company, and we found that this company has the right ingredients to become a multi-bagger, because they will play a positive operating leverage, because their operating leverage is more than 1.5. That is the cutoff for me. Historically, they have hit around 1.5 almost 4 times out of last 8 years. So I can be sure of that. And you can see in FY18, which was a peak year for them, the operating leverage was 2.5 times. So I expect this is the best proxy to play in wind. When wind would be doing great, this company would do well than when all the OEMs put together. So let's talk about valuations. Just so one company which I think is closer to this company, whose journey I can relate to, is PT Engineering. So PT Engineering, if you see, this is a valuation chart of PT Engineering, which is into blue, and black may this company SGIL is there. You can have a top view, and you can see that the EV by EBITDA has expanded. They all have, SGIL had a better EV by EBITDA till July 2023. But afterwards, what happened that now PT Engineering is having around 30 times of EV by EBITDA against SGIL having just less than 20 EV by EBITDA. Why I'm using EV by EBITDA? Because both the companies are leveraged and they have a different mix of leverage. So that's why we have to look at EV by EBITDA as the metrics to valuation metrics. So there is a gap between PT and this. And why this gap got created? Just look at the bottom picture. In last 5 years, in March 2023, PT Engineering was having a 13.76 operating profit margin. Now they are having a 15% operating profit margin. So this jump has actually increased the valuation gap. The valuation re-rating happened because their OPM has gone from 13 to 15. And this was happening because of they added the machining capabilities, and also they have acquired some smaller companies. So this, I'm not adding additional capability building, but just by adding machining capability, the margin expansion from 13 to 15 is quite immediate, because I've seen PT doing it consistently for last 1 year and with the machining. So, and PT also has Siemens as a client. So, but PT is diversified. They are into railway, and their major portion is coming from railway casting business, not wind. Wind is hardly 10% for them. So it's not like to like basis, but still you can gauge a sense that both are casting companies, and they will be rated by 20, 25, 30 kind of EV by EBITDA. So just closing the loop on valuations, some thoughts on FY26 numbers. Revenue, if company says 450, let's assume for a minute that they will hit a 450 crores. Then EBITDA margin for 26, they are saying 18, but I'm assuming 15%. So EBITDA, I'll gather around 67 crore if that happens. Then EV by EBITDA, if I assume that a market would give me a 5 multiple more than current EV by EBITDA, which is 20. So 25 EV by EBITDA, which is lower than the PT's around 29, 30 kind of bracket. So I'll get an EV of 1675 crores, and the company will be having additional 20-25 crore of debt, which is the part of the plan because they are doing Capex. So 120 crore of debt would be there. It could be furthermore, but if I reduce even 150 crores, then I'll get a market cap of around 1500 crore, which is exactly double of the current market cap. The key risk here is the project execution risk, because the company has not been able to do justice to their guidance in terms of project timeline. So that is the tricky part, that whether they'll be able to close the loop by FY25 or it will go to FY26. And the second thing, which is leverage. So balance sheet is not great. So they need to contain leverage. And that's why they need a financial discipline. And if they can do that well, this company is a very rock solid candidate for re-rating. And margin risk is something which I can see that, but 12 to 15% margin is kind of inevitable. So my business model doesn't take that much of margin risk. My protections are beyond margin risk, because you can watch out for margin. So these are the risks which I mentioned. And that's all from my side. Thank you for this opportunity.
Content of this video is for educational and informational purposes only and should not be considered financial, investment, or trading advice. The information presented is not a recommendation or endorsement of any particular investment strategy, security, or financial decision. Investing involves risks, and viewers should conduct their own research. The creator of this video is not responsible for any financial losses incurred based on the information provided.